let's go into our hockey helmet and take your questions and I'll answer them. So let's start off with, will there be an interest rate hike on October 25th? Well, before that date comes, we're going to get the September CPI. We're going to get the jobs report, and we're probably going to get some of the GDP numbers that are going to come out for September, and that'll give us an idea of how the third quarter went. The prediction business sucks. So what I think could possibly happen is it's leaning towards a hike. If it's not going to be on the 25th of October, it could be at the December meeting. But, you know, the governor has indicated that there is still an opportunity for an increase if inflation doesn't move downwards, and it doesn't look like it will come September by any significant amount. And we could very well see another hike. The positive is, you know, we may possibly see the variable rates be very close to the fixed rates as the bond market has spiked by about 50 basis points since the beginning of September. It's now moving some of the fixed rates into that mid 6% range, and maybe that variable product could pose a potential opportunity if the if the Bank of Canada signals that you know, they're at the end of the rate hike cycle. But chances are, I don't know if we're there yet. And it's still too early to say that we're at the top of the market, because this bond market is rallying. It broke through that resistance level of 418, and it just spiked. And I'm concerned that we're going to see further hiking in the near future, and it's not going to bode well for those that are coming up for renewals, because it just doesn't give them choice. It'll handcuff them. A lot of people are going to be stuck in their homes. They can't even renew their mortgage elsewhere. They can't shop because they can't qualify. And just to put things into perspective, when you're in the 6.5 range on fixed rates, you have to qualify at that rate plus 2. So seeing close to 7 handles on some of these rate renewals, you might have to qualify close to 9%, which is a far cry from the top end of 5.25, 485. We were qualifying people under the stress test when rates were at 2.5, 3%, because everybody was getting qualified at 5.25, and that was a bump of 487 from this vintage that's coming up for renewal now. So we'll see what happens. Are you seeing an increase in defaults yet? Well, not necessarily a flood of them. We are seeing some people having some difficulty, and we are walking them through different options. We've only seen a couple that are 90 days in arrears, and trouble is brewing as they're starting to get legal letters and enforcement action notices. But the reality is people are doing whatever they can to keep their home. Okay, they're selling things, they're scraping by, they're racking up credit cards. They're basically racking up the unsecured stuff to protect the secured stuff. So, you know, we're seeing some interesting situations, and I'm sure that this Thanksgiving and Christmas season, there's going to be a lot of folks asking for help from parents, from relatives, from siblings. We're going to see a lot of that. So be prepared. If you've got a big gathering, somebody might be pulling you aside looking for some help, because that's just that time of year. When do you think rates will move back to normal levels of the past few years? Okay, this is a really good question, and I want to be very clear. I don't think we will see anything near the rates we were used to. The era of low interest rates is gone. Cheap money is gone, okay? I think when all the dust settles, we'll probably be used to 5-year money in the 5% range, maybe high 4s, but nowhere near the 2s and 3s that we were grown accustomed to. It created unnecessary risk in people's decision making, because they thought things would be low forever and they could just carry debt and not focus on paying down debt. And for anyone who's watched me on CP24's hot property for 19 years and has watched this show on a regular basis, I'm a big believer you got to pound down debt. You got to get rid of debt, okay? Because when you get rid of debt, nobody controls you. And you got to pound it down at an accelerated pace to protect you and your family from this type of activity. Now, it was good for a very long time, but not having any debt, okay, gives you control. So I don't think what you experienced in the last 5-10 years is going to happen again. When should I buy and what type of property should I consider? If you are fully qualified, and I encourage every first-time buyer to get pre-qualified so you know exactly what you qualify for, and you should probably reset your pre-approvals if you're at the end of that 120-day rate cycle, because if you're hitting that 90 days, chances are you buying a place within that 30-day mark isn't going to happen. So you want to extend that pre-approval, so you want to reset the rate. I would hold off. I think there's going to be continued increases to the housing stock that's going to be available for sale. Listing activity is increasing as more and more folks start coming into that peak renewal period, where remember, we still have more than half of Canadians that haven't seen a renewal. Okay, at the end of this year, we're going to be at 47% of Canadians having gone through that shock of higher rates at renewal time. So as more and more people see the shock of higher payments, they may start saying, you know what, this isn't for me. I don't want to carry debt for the rest of my life. I may just unload. Okay, we're seeing that on the investment side. We're seeing people not cash flowing, so they're getting rid of investment properties because they don't want to carry the negative cash flow. So I think there's going to be an opportunity over the next 3 to 6 months where more properties will be available for sale. So I wouldn't necessarily rush out and get one. And as far as what type of properties you buy, I really like the low-rise opportunity. I really like, townhouses, single family, semis. I'm not a big fan of condos right now. I think there's going to be a glut of them. I think they're not necessarily a good long-term play based on what my thoughts are on that. I'll get into that another time. So I would really look at the low-rise. I think with the new legislation in the various municipalities allowing multiple units on a property, it really gives you that ability to increase your return on your investment. If you need to convert a basement into a unit, you need to add an addition, put a garden suite, laneway suite, whatever the case is that allows you to maximize the return on that piece of real estate and gives you opportunity to plan into the future. So I guess my point is be patient. You're going to have more choice. And if you're looking to get in the market, buy a low rise. Try to stay in that single family, even if it's a smaller home in not the greatest area. If you're in the city, you're in that vicinity to transit and major arteries, transit arteries, that's going to be good for you long term. What are some programs available to first-time buyers that can help them get into their first home? Some of the programs available are the First Home Savings Account. Okay, this is a new program that was introduced last year in the budget. It's now available at most lenders. You're able to contribute $8,000 per year, up to $40,000 in total. So you could contribute $8,000 a year, every year for 5 years, or total of $40,000. And that contribution can earn interest income. It can earn capital gains if you invested in the stock market, EFTs, or whatever the case is in this plan, tax-free. And your contribution is tax deductible on your income. So if you're in a 40% tax bracket, for example, and you contribute $8,000, you will be able to get a $3,200 tax return, which you can add to a second contribution the following year. So it's a great tool to use. Once it's withdrawn, unlike the home buyer plan, it's non-repayable. So it's a really good opportunity that if you are buying a home this year, make the contribution. Make the contribution right away, and you get the benefit of that tax deductible amount of $8,000 per person. And it's a great tool to increase that savings of your down payment and help pay for your closing costs, land transfer taxes, and whatnot. So that's one of them. The second one is RSP contributions. Under the current programs, you're able to withdraw $35,000 out of your RSP under the home buyer's plan. Okay, there are a few caveats. One being the amount you contribute has to be in the plan at least 90 days. Okay, so if you're buying a home and you want to take advantage of your over contribution limits in your RSPs, you have to have those monies in the account for 90 days. If you do not have those funds that you withdraw in the RSP for 90 days, they will disqualify the ability for you to defer repayment over 15 years, and you're going to have a taxable amount on the amount you withdrew. Okay, so that is another tool. The third one is your tax-free savings account. You can use it for anything, but that's another way you can save money and earn interest that's tax-free, which could be another tool. And then in Ontario, there's a few land transfer tax rebates. You got to speak to your lawyer because it's all relative based on the purchase price. Usually it's for properties under $400,000, and it's a matrix used to see what rebate you get. But it's a one-time lifetime chance you can use it, and it's got to be applicable based on the price. Speak to your lawyer; they'll give you details on that. I'm going to wrap it up. I want to thank everybody for tuning in. Have a great weekend. Enjoy the weather in the coming week, and we'll see you next week.